enable.
UTI Mutual Funds and CNBC TV18's Financial Advisor Awards are one of India's most prominent awards in the financial market space that honor the best financial advisors who have set a benchmark in the industry by maximizing investor returns through sound advice in highly volatile markets. The 9th edition of the Financial Advisor Awards is in the making. Over the years, these awards have emerged as a coveted platform that rewards not just the wealth preservers across the length and breadth of the country, but also throws light on the opportunities and challenges that lie ahead in the financial advisory field.
The life of a financial advisor, as for a business channel, is supremely easy when markets are at all-time highs. No challenges at all. Even if we sit passively, you will have your audience or your clients coming in simply because the markets are doing that work for us. Today is a day of celebration. I congratulate every one of you on behalf of CNBC TV18 and invite you to enjoy this evening, which is dedicated entirely to you, the financial advisors. Thank you very much.
It's a pleasure at ICRA to be associated with CNBC TV18 and UTI in powering these awards over its multiple editions. It's almost been a decade, since we've been partnering CNBC TV18 and UTI for these awards. In these years, as was pointed out, the numbers have grown significantly. The awards have grown in terms of importance, and every winner we have seen would like to prominently display the fact that they win this award. So it's very, very important for the winners and the participants.
If I may just say that it's a genuine privilege for us to always have this annual event along with ICRA and CNBC, because UTI was indeed created for the purpose of democratization of access to financial markets. And the only way we believe we can do that in this country for many years to come will be by essentially expanding the base of financial advisors and distributors. So we are quite sincere about our commitment to continue to develop this community right across the length and breadth of the country. And that's why we continue to take special pride in this event.
With over 39,000 applications received for nominations in different categories, the jury of distinguished experts from the industry had the uphill task of finalizing winners from the best financial advisors from across sectors and regions.
Considering the humongous amount of attraction this award has received, a CNBC UTI Financial Advisor Award, we have seen an overwhelming response from the candidates, and the nominations forms have been overwhelming across the country, and we have received from across the board, whether it is bank, financial institutions, retail based financial advisors, and everybody is looking forward to be part of this process and prove themselves that they are doing very good job in terms of attracting more and more investors to the mutual fund industry.
I think this is my third year to be part of the jury. I have been very fortunate here. I must share with you that it has been a very refreshing experience, and I won't hesitate to say, as compared to the previous years, people had come very well prepared. I was looking at some of the leading institutions of the country, and the seriousness by which they were taking up these awards speak volumes of the credibility of this particular award at the first outset.
The applications from the IFAs were quite good across the region. The shortlisted applications were presented to us, and the quality of applications was very good.
What I liked about them is they are quite passionate about their businesses, and they are quite detailed and enthusiastic in terms of sharing their experiences and overall approach towards the investment philosophies in financial advisory business.
I think CNBC Financial Advisor Award is like an Oscar for the financial advisory industry, and it's a standalone platform where you recognize the people based on their credibility, credentials, and how many years they have given in the industry.
I think one of the important things about Financial Advisor Awards is that it brings in the best of industries at the same platform and kind of recognizes their efforts.
The Financial Advisor Awards platform has been one that we've been coming to regularly. It helps us showcase our thought process, and we get to meet a lot of our peers here as well. So it benefits both ways.
We have been participating in these awards for the last more than 4 years, I understand, and it has a great repute at the end of the day. And we feel the way the whole awards are designed and the way it has been acknowledged is very important for our whole brand. And we have been here winners for the last 4 years in this broking category. So we are very positive about the whole thing.
I think it's a great tool and a great platform where you can actually come and showcase that what you have done over the last 1 year, and then you're actually competing among the best.
We have won this award in the past, and it has given us a lot of credibility with our investors, especially with our prospective investors.
If we win the award, it's a great recognition of our efforts over the years.
You know, all the names concerned here, UTI, CNBC, are terrific brands. And if we feel like, these names have said that we are one of India's finest financial advisors, it adds tremendous value and tremendous credibility. So when new customers approach us, when they hear that we won this award, it really has a big impact.
On the other side, we take a look at the journey of the Financial Advisor Forum that brought industry experts and their insights to different cities in India. Every year, the Financial Advisor Awards bring together industry experts and the local financial advisor community at the Financial Advisor Forum conducted in different cities to discuss the trends and opportunities in different sectors.
Krishnan, you're deeply involved with retail clients. So what are the biggest pain points that financial advisors need to be addressing as far as young consumers are concerned today? And a lot of them are taking on to the internet and getting into direct plans, buying things by themselves, reading up. So in that sort of a scenario, how does a financial advisor show value, his or her value to client?
Only thing is, you have to keep things very simple. As far as the new generation, the new set of investors are concerned, as far as the product is concerned, what we need to concentrate is they don't want to get into a complicated kind of a product. One thing what we need to provide them is a simple product to suit to their need. One, this is as far as product is concerned. Second, execution. Execution, they are naturally not interested in filling a paper and taking more and more papers. So you need to provide them with all options, maybe quasi-online or online. So I think if you take care of both, simple product, easy execution, I think that will satisfy them very much.
So in my experience, when I've been dealing with youth, I think the biggest challenge you face with them is how do you get them into this habit of regular saving?
Correct.
Generally when you look at young people, you get your first salary, you want to go and enjoy yourself. There are a lot of dreams, aspirations that you have built up for. So I think getting them to get started to think, that how saving regularly and early on in their career and how it will make a big difference, I think is fairly important.
Taking from where Suraj left, what is happening today is the defined benefit plans, which probably a generation before enjoyed, is no more there. So they will have to invest and save for themselves, and which is very important. And if you look at life expectancy increasing, it's phenomenal. They already say that the person who's going to live 150 years already born. I mean, if you're talking about that kind of life expectancy, even if you're living 95 years, you're working.
The retirement age will surely have to go up.
Surely have to go up. I mean, you can't have an accumulation phase being 30 years and distribution phase being 35 years. So I think it's very important they start earning. The moment they start earning, they start saving. If they don't do that, and I think that's where the advisor's role comes in. It's not only about transactions, it's about hand-holding. It's about managing the investor more than the investment.
Right.
So if you do that correctly, that's where you're going to contribute. And financial behavior is going to be the most important aspect and not just execution or setting up platform.
Firoz, one of the big changes that this budget has brought about is the introduction of the long-term capital gain tax on earnings from mutual funds. How does that change the game for the IFA community, and what's your advice to them? Because this is a point that pretty much every investor is picking up right now with their advisors.
When you look at long-term capital gains, if you're used to and accustomed to, as an investor, for 13 years of not having long-term capital gains, it's certainly going to dampen the mood. But if you find out the rupee value impact of this decision, then you will be able to clarify to your client very clearly that it's not as big an impact as it seems to be. For example, if I told you 3 things which you can tell your investors to distinguish and clarify that it's not a big impact. First, the difference between any other kind of taxation and this one is that most other heads, the other 4 heads of income tax, get paid in that specific financial year. This gets paid at exit. If you defer your taxation, if you defer your exit for 10 years, your effective tax rate comes down from 10% to 5%. If you defer it for 20 years, quite a few personal finance goals are 20 years away. If you defer your taxation by not exiting for 20 years, your effective tax rate is only 3.5%. Because you have the tax amount with you for the rest of the 19 years to compound and then at the end pay. That's point 1. Point 2, a family of 4, let's assume have a 10 lakh rupee investment today, which is a reasonable size customer, will earn 30 lakh rupees in the next 10 years if 15% is the growth rate. He or she, the family, gets almost about 36 lakhs of exemption in the form of 1 lakh rupees. So where is the long-term capital gain? A 10 lakh investor is expected to earn 30 more lakhs in the next 10 years, but has an exemption limit as a family of 36 lakhs per person, 1 lakh rupee for 9 years into 4. So the point being made here is, that's the second point, that the long-term capital gains can be significantly lower than 10%. And the third point is that you can definitely look at the silver lining across the dark cloud, saying that long-term capital losses now become useful, unlike in the past. So these 3 points, if you actually use to your merit, the effective tax rates are significantly lower and cannot change largely the case of equities anyway.
CNBC TV 18's Lata Venkatesh, in a conversation with the MD of UTI Asset Management Company, Leo Puri, discussed the favorable markets, SIP culture, and the Indian investors coming of age.
I wanted to ask you about this SIP culture itself. Do you think it's here to stay?
Yeah, it seems to have now settled down. I think the fundamental drivers, we've all talked about financialization, reallocation from gold and real estate, which is quite a fundamental driver. Rising affordability compounded with middle class tendency to save is another factor. And then, of course, the shock of demonetization bringing further liquidity into markets. So there have been a number of things which have coincided here, which I think have altered this. But over and above that is a much higher level of confidence, partly due to the political changes that happened 3 years ago. So the macro backdrop, the governance foundations are stronger today. So the middle class seems to have a high degree of optimism around where the reforms process is going as well. So all of this have conspired. It has helped, obviously, that returns have been good because that reinforces this virtuous cycle. And so it's in fact about 5,000 to 6,000 crores which is coming into equities every month at this point in the form of SIPs. But that's a very steady sort of flow because that gives you that 60 to 70,000 crores a year, which is a very large sum of money, obviously, and supporting the markets. So far, certainly, the story has been very positive.
Is it that this large amount of money as a whole that the mutual fund industry got was inordinately due to demonetization, and therefore should we look at some of the money as one-off?
No, I think demonetization was an added driver of some of the additional liquidity that we got. But the underlying factors were the others that I mentioned, the financialization and the sense of underlying optimism around the reforms process, combined with global liquidity keeping prices steady. So these are the factors ultimately. But I don't think we can underestimate demonetization as money came first into the banking system and into CASA accounts, and from CASA accounts in search of high yield, there's no doubt that some of it has found its way into mutual funds. And this is true of small and medium enterprises, commercial enterprises, as well as households.
We had some advantages in the sense that our macros were very good. The Monetary Policy Committee has committed to keep inflation down, and that also meant fixed income is not that attractive, real estate not that attractive, and therefore money has come. If the cycle were to turn for whatever reason and gold and real estate again became expensive, do you still see Indian investor keeping the faith in mutual funds?
Yeah, actually, I'd have two nuances to what you just said. One, some of the financialization is the fact that gold and real estate as a haven for black money are less secure than they were earlier. Okay. So it's not all about relative yield. Relative yield has been the other factor, is the economic driver, because relative yields have been low and volatile in the case of gold and low in the case of real estate. So no doubt about that. And I think actually it would be a healthy thing to the extent that with asset allocation, people in a normalized real estate market, post-RERA, better organized, a clean market, do come back and start allocating to real estate. That's a good thing to happen. And I hope and I expect it to happen. Gold is a more complex asset because of the emotional content, and people can debate how rational it is, you know, as a store of value. But gold too will somewhat come back into favor. But the laundering aspect of those asset classes will be much diminished in any case, and I think that will not return at this point in the country.
That's good to hear, actually, to believe that this trend, is sustainable. But more importantly, there are people who keep telling us, fund managers and even non-fund managers, that this is only the flow that is coming to mutual funds. The stock of Indian investments is still in real estate, and that might shift. So there is another wall or wave of money that could come. You agree with that?
That depends, on how you look at the stock of Indian real estate, actually. I don't think it's, I wouldn't draw that simple correlation. Yes, I think that's a little bit of cheerleading and optimistic thinking. A lot of the stock in real estate is obviously in land, which is put to various forms of use. A lot of it is agricultural land as well. There is a small component of speculative investments that were in the real estate sector. Unlocking those is actually going to take some time. I don't think it's going to come back in a hurry into financial markets. So I think this is more a game about flow than about stock. The other thing that is happening is that a lot of money is coming into fixed income as well, actually. We've seen very healthy gains in fixed income markets because of the rate cuts that have happened hitherto. People have made healthy yields and double-digit yields out of fixed income investments. So we should never underestimate the importance in the mutual fund industry of the role fixed income has been playing in addition to equity. Even today you can get, let's say, 8.5% from good quality corporate bond funds, which is maybe 1.5% or 2% above fixed deposit yields. And that's a pretty healthy return. Around the world, people are having to think of what normalized returns might be in a world of lower inflation. And if you believe inflation is going to be plus minus 4% in India, then really, yields of 8% from fixed income are very, very attractive.
Absolutely.
And we must learn to look at it that way and not, shy away from that.
With the market booming and mutual fund investments gaining new momentum, the role of the financial advisors has become more crucial than ever before. And the awards this year will highlight the contribution of those who are able to distinguish themselves by taking new investors on the path of wealth creation while helping existing investors through volatility and market cycles.
Focus, ideate, innovate, enable.